Hi there, welcome to Grain TV. It's Thursday, February 25th. I'm Kevin McNew. We had a mixed day in grains. Let's take a look at the Grain Hedge trading platform and see where we closed. In Chicago, corn off 4 1/4. Beans off 8 1/2, and wheat bucking the trend, gaining a paltry 1 cent a bushel. There's a bit of news out today. Most of it was fairly negative for the grains. Let's take a look at some of the key indicators that were coming out today. First of all, the big news was USDA's Ag Outlook Forum. We'll get into the details of what they said, but overall, they look for bigger corn acres, lower wheat acres, and lower soybean acres than what analysts had been expecting. But overall, the chief economist from USDA painted a very gloomy outlook for the coming year in grains in particular. Other news out today, Egypt was back in the market buying 300,000 metric tons of wheat. None of the countries doing business with Egypt turned out to be from the U.S. It was all Romania, Ukraine, France, and Argentina that got in on the deal. So yet again, U.S. wheat remains fairly uncompetitive in the world market. Other notes that are important for traders: tomorrow will be the last day to be long in the March contract, with Monday being first notice day. So if you are long in March grains, it is time to roll those positions into either May or July. Let's take a look at Thursday's export sales from USDA. Here we did get a little bit of a silver lining in wheat, with wheat coming in at 486,000 metric tons for both old crop, new crop combined. That was above analyst expectations of 200 to 400,000 and above last week's 307. Corn and beans coming in line with analyst expectations, although beans was certainly on the low side, with only 328,000 combined for old crop, new crop versus last week's 595,000. Let's turn now and talk about what USDA saw in their Ag Outlook Forum this morning. And let's keep in mind that these numbers they're putting out are not based on formal surveys. They are really just guesstimates, if you will, from the economist at USDA. But nonetheless, at this time of the season, without any other firm numbers, the market continues to focus on it. And going into this report, analysts had been looking for about a 1.5 million acre increase in corn, about a 600,000 acre increase in beans, and about a 2 million acre decrease in wheat acreage for the 2016 crop year. USDA sort of kept those benchmarks in place, although they lowered wheat acres much more than what analysts had been looking for. USDA calls for a 3.6 million acre drop in wheat acres. On the other side of the spectrum, we have corn, where they are looking for a 2 million acre increase over last year's planting, and soybeans coming somewhere in the middle, with only about a 2/10 of a million acre decline over last year. In terms of price outlook, here's where it gets sort of gloom and doom. When they showed their USDA average price for the coming marketing year, they look for all three grains to have weaker prices in 2016 versus the current marketing year average for 2015. In corn, 345 is what USDA is calling for as a U.S. average price next year versus 360 this year. In beans, 850 this year, or 850 next year versus 880 this year. And then wheat, even worse, at 420 next year versus $5 this year. In our expectations, what USDA is saying is we're going to have more gloom and doom in the coming year. Let's put that into perspective of what those acreage numbers that USDA have in store for the coming marketing year, what they mean in terms of potential prices for corn contracts and November bean contracts as farmers start to enter the planting season. First of all, let's talk about corn. With USDA's big 2 million acre increase, that has the potential to really put ending stocks on a much higher trajectory. Right now, our ending stocks are about 1.8 billion bushels. With USDA's 2 million acre increase, that would put our ending stocks about 2.1, 2.2, somewhere in that range, which puts us around a 15% stocks relative to use ratio. If that is the case, and we see those acreage numbers at the end of March, and we get into planting season with things looking ideal, I wouldn't be surprised to see Dees corn trade down in the mid 350 range. Right now, even though we've been under pressure in the last week, we're still at 380. I think there's still much more downside here with these numbers that USDA has painted. Same scenario for beans, unfortunately. Those acreage numbers for USDA don't really do much of a make much of a difference for the soybean market, because we continue to have very large carry out from old crop this year's situation into next year. So even with a slight reduction in acreage, it doesn't really help the bottom line in terms of carry out for 2016. So if we see those acres numbers in line with USDA's expectation from today, then that continues to put more pressure on carryout, growing carryout from right now around 11% stocks relative to use up to around 13%, which in my guesstimation puts the November contract somewhere in the mid to low 8.30 or mid to low $8 range versus where we're at today at 8.80. So if you're a farmer, I know this is a painful time, but the times may be even getting worse. With USDA's projections now in play, we're going to sort of continue probably to trade lower. We're getting closer to those lows that we established back at the first of the year. I suspect we'll test them in the next week and potentially move lower. So if you're a farmer, I think it's time to really start to pay attention. If you're interested in getting a trading account to hedge your risk, market your crop a little more efficiently, then give us a call, 877-472-4607, or as always, visit us online at grainhedge.com.